This is Barry Zalma speaking for Claim School Incorporated's blog, Zalma on Insurance. Today we're going to speak about why the overcharge of force-placed insurance provides a defense to a foreclosure, and that overcharging for force-placed insurance provides the special defense available to the mortgage holder, to the borrower, of the good faith and fair dealing requirement of every contract, so that in an action to foreclose a mortgage, the trial court granted in part the plaintiff's motion to strike the defendant's special defenses and counterclaim. Subsequently, the court granted the plaintiff's motion for summary judgment as to liability only, and thereafter the court rendered judgment of foreclosure by sale, and the defendant appealed. In M&T Bank versus Robert R. Lewis, the Supreme Court of Connecticut on April 30, 2024, dealt with the foreclosure judgment presented with one question important to insurance professionals, and that is whether the allegations of impropriety in a mortgagee's forced placement of property insurance arise from the making, validity, or enforcement of the mortgage for purposes of the special defenses to a mortgage foreclosure action. Robert Lewis claimed that the trial court improperly granted the plaintiff's motion to strike two of the defendant's special defenses arising from the plaintiff's conduct in its forced placement of flood insurance on the property at issue, alleging that the plaintiff had unclean hands and breached the implied covenant of good faith and fair dealing on the ground that those defenses do not arise from the making, validity, or enforcement of the mortgage. After the defendant failed to make his monthly payment on August 1 of 2017, the plaintiff notified him in writing of his default, and the plaintiff subsequently elected to accelerate the note and foreclose on the mortgage. The parties participated in a state court-supervised foreclosure mediation program but were unable to reach an agreement to modify the loan. The trial court granted the plaintiff's motion for summary judgment as to liability. Defendants claim that the trial court improperly granted in part the plaintiff's motion to strike the defendant's special defenses of unclean hands and breach of the implied covenant of good faith and fair dealing predicated on the plaintiff's improprieties in the forced placement of the flood insurance do not arise from the making, validity, or enforcement of the mortgage. In the present case, the trial court struck the special defenses and the specific mortgage in question. The question remained whether these allegations by the defendant are sufficiently related to the making and validity or enforcement of the mortgage. The Supreme Court concluded that they were. The defendant alleged that plaintiff charged the defendant an amount greater than the cost of the insurance in violation of Section 5 of the mortgage agreement, concealed a kickback agreement that it had with the insurer, ASIC. All of this alleged conduct is directly related to the plaintiff's reliance on and enforcement of the mortgage agreement. The Supreme Court noted that the alleged effect of the plaintiff's conduct in enforcing Section 5 of the mortgage agreement, that it wrongfully increased the defendant's overall debt, provides a sufficient nexus, according to the Supreme Court, to the foreclosure action, and defendant's allegations in support of the special defenses were sufficiently connected to the enforcement of the mortgage. Since an action to foreclose a mortgage is an equitable proceeding, it is fundamental that in equity jurisprudence, that for a plaintiff to show that he is entitled to the benefit of equity, he must establish that he comes into court with clean hands. The clean hands doctrine is applied not for the protection of the parties, but for the protection of the court. It is applied not by way of punishment, but on the basis of considerations that make for the placement of right and justice. A mortgagor who has defaulted on a mortgage is not precluded from asserting the special defense of unclean hands. Therefore, the Supreme Court took the defendant's allegations as true and concluded that the defendant alleged willful conduct that is not equitable, fair, or honest, the kickback scheme alleged. The defendant sufficiently pleaded, therefore, that the plaintiff's alleged misrepresentations interfered with his right to receive the benefits of the agreement. This defendant did so by alleging that the plaintiff's kickback scheme wrongfully resulted in the defendant's payment of more than he was obliged to pay and more than the plaintiff was entitled to charge him pursuant to the mortgage agreement. By so alleging, the plaintiff's conduct with force-placed insurance increased his overall debt, and the trial court improperly struck the special defenses. And so the case went back to the trial court. In my opinion, insurance is important to every mortgage, needing it to protect the security for the loan. Mortgages require insureds to obtain insurance and allow, if they fail, to obtain force-placed insurance that only protects the mortgagee at the expense of the insured. However, the mortgagee should never charge the insured more than it pays, since that would be fraudulent and, as in this case, a defense to the foreclosure as a non-equitable device. This video was adapted from my blog, Zelma on Insurance, which is available free to anyone who clicks on the URL zelma.com/blog. You can subscribe to the blog posting, and if you do, you'll receive notice of every blog, usually 5, sometimes 6 a week, and access to the more than 4,800 blog posts. Please tell your friends and colleagues about this blog and the videos. And if you watch the videos, please click on the like button on YouTube and the thumbs up button on rumble.com. And if you're interested in further detail about insurance, insurance claims, insurance law, and insurance fraud, please consider, for a very small fee, subscribing to my Substack publication. Thank you for your attention.